All right. So now, after we saw that huge run from December 23rd, where it popped from that $21 level all the way up to $60 a share. And as I say, I was out, but they dragged me back in. It's like Al Pacino. They dragged me back in. Why? Well, because of this, because we've got these billionaires fighting, and because we've got so many of the folks over at Wall Street Bets and Robin Hoodsters and all the rest piling in and fighting each other. Dramatic fashion, they're fighting each other here. So what I'm looking at, folks, is that GameStop short seller was down 30%. That would be Melvin of Melvin Capital. Down 30% this year, and he got a $2.8 billion bailout from Stevie Cohen, the gentleman you see on the screen there, the guy that owns the Mets now, as well as Ken Griffin. So those two billionaires lining up and funding a guy who's made a bad bet, but perhaps is getting squeezed in legendary fashion right now. So what I was noting was, as this squeeze was going on, I saw another billionaire, Chamath Palihapitiya. He was following these Reddit investors that I spoke of, the Wall Street Bets guys. And just as I said in print yesterday, I mean no disrespect to any of you over on Reddit and those Wall Street Bets guys. In fact, I'm going to be speaking to Jamie, the founder of Wall Street Bets, on Thursday on my podcast. How about that? So what I'm talking about here, folks, is that a lot of the sorts of trades that people talk about, and in some cases back up by showing their trades on that Reddit thread, Wall Street Bets, the ones that I look at, a lot of them are YOLO trades. You only live once. I'm putting it all on black. I never put it all on black. I keep some over here and some over there, and I'm constantly moving money around. I don't like to swing for the fences. I swing for singles and doubles because I want batting average, especially at this stage in my life. I've done pretty well trading for 39 years. It'll be 40 years in September. And what I like to do is go at the highest potential returns that I can get for the lowest risk or exposure in the markets. And so that's what I do. Now, Chamath is a smart guy, worked over at Facebook with Mark Zuckerberg. Now he runs Social Capital. Nothing but respect for you, Chamath, but I think he's wrong. He's buying calls, out of the money calls, and he paid as much for these out of the money calls as I paid for the stock back in December. Now, does it mean Chamath's going to be wrong? No. Does it mean I'm going to be right? No. I'm just pointing out a fact that the price he paid for these calls was more than the stock was in December, okay? Now, that in and of itself is not enough to get me to make an investment. But as we ran from 21 to 50, 60 bucks, and then we saw that moonshot that carried it to 159, and then whoosh, back down into the 70s, I think. Yeah, 70s, just yesterday. I'm telling you, as most of you know, that's not normal. We've got an epic short squeeze going on here, and I wanted to put on a limited risk trade, and I wanted to have exposure to a potential move back down from whence it came. So what did I do? Well, let me show you. First, getting another fill here, just one sec. I trade throughout the day, as most of you know. And by the way, I'll be back on the halftime report tomorrow with my buddy Scott Wapner. All right, so here's one of the trades that I put on. That is a screenshot of the trades that I did. So you'll note that I bought GameStop 60 puts, paid $21 for those, with the stock over 100. So in other words, $40 out of the money puts. I'm buying those. What did I sell against them? I sold those March 50 puts for $13. So those were more than $60 out of the money when I did that trade. So those March puts against my April puts. So first of all, I have time. I've moved it a little in my favor because I have more time for my April puts to be right. And I'm short puts in March at that 50 strike. as you see, paid about $216,000 for my longs, collected about $130,000 for that short position. Then I also went out here and sold a put spread, a spread that can only go to $10 because, as you see, the 40 puts are what is the strike price for these puts in April that I'm short, and collected $105,000 for those. Then I went out and covered those with the 30 strike puts for $6.35 and paid about $60,000 for that. So you put the whole mess together. Maybe I've tied up $100,000 or thereabouts for this trade. Now, what I'm looking for, folks, is if this fever breaks, doesn't mean the stock has to go all the way down, to 21 where it was in December. Doesn't mean it has to go down at all. But I think eventually the short sellers will be bought in. None of the positions you see on the screen here that I am doing are short the stock. So in other words, nobody can make me buy in short shares. All those people like potentially Melvin Capital and anybody else who's piled in on the short side, they could be forced to buy in. That is much of that squeeze that you hear me talking about here. So I think when that fever breaks, the stock comes back down, perhaps to 100, perhaps to 80, perhaps even to 50. Does it do it all in a day? Hey, it's crazy out there. It could happen all in a day. Does it bleed off over time? Because unlike when Carl Icahn was going against Ackman for his Herbalife bet, Ackman at first was unfortunate enough to be in the short stock position. And Carl Icahn went in and put on some call spreads and was able to profit mightily on the squeeze. But nonetheless, you don't get bought in if you have puts. If you have puts, that's a way of expressing a short view with a limited amount of risk. So in other words, I've got limited risk trade on here, and I'm not going to have to borrow shares from somebody who does not want to lend them to me or who wants to lend them to me at a very dear price. So that's why I've established this trade, folks. I think it makes a lot of sense. I'll keep talking about it as I adjust and so forth, but I wanted you guys to know that that's how I did it. Note that those are one-to-one spreads, that I have one April 60 put against one March 50 put. That's a one-to-one call vertical spread, and what I've put vertical rather, and what I've done is I've stretched it out in time because I'm long April, which has 30 days more to trade than those Marches. And guess what? March, it looks like earnings are after these March options expire. If that's indeed the case, I could end up having my long puts in April, depending where the stock is. Those March puts could expire worthless, and I'd still have another bite of the apple and be able to sell more puts into this against my long April puts. So that's the position I've established, folks. Full transparency, you see it there on your screen, and we'll talk about this as we move further down the line. There was GameStop when we established that position, about 115 a share. Presently, it's 147. So to all the YOLO players, I salute you. Congratulations. My spread's still out there. And again, this is something I think that plays out over time. Happy to hold it. Let's see how this whole thing works out. We've had several halts today, by the way, in the trading of GameStop.